Hey, what's up, guys? Andrew here from Trading Options Daily, again with a special video for you guys. If it's your first time here, thank you for stopping by. Make sure you subscribe and follow along. Today's video is all about the 3 economic secrets the banks and government don't want you guys to know. I'm breaking down if the economy is doomed. We're talking about inflation versus interest rates and how you protect yourself and your assets in the long term. This is a pre-recorded session from a previous event that I hosted, so I hope you guys enjoy this one. Keep checking in for new videos. Thanks for being here. And now it's time for kind of to bring it a little bit maybe in a fuller picture and the economic secrets that the banks and governments aren't really going to tell us. They don't want us to know these things. And like I'm putting this together, like I'm admittedly like a bit of a numbers guy, and going through this, it's kind of my thing, kind of my jam, kind of a nerd that way. So I had a lot of fun putting this together, and I hope you guys enjoyed it as well. But we're trying to get like a full scale view of what's happening so we can better understand it and better set ourselves up for success as we move forward to our eventual like financial destiny. Okay, so let's get into this. Let's get into it and finish off the day strong here. Okay, so we have about 40 minutes to go through this stuff, and we're going to start with an economic update. Just kind of pull back the curtains like Wizard of Oz style. Okay, if you've seen that movie, the old school one, we're going to pull back the curtain behind the machine, see what's really going on in the economy, where it's headed. Then we're going to talk about inflation, and we're going to talk about kind of what you've already been feeling at the gas pumps and the grocery stores. But we're going to look at why it's happening, how the government may try to use interest rates to like fix is quotation marks, to fix the problem. And then lastly, we want to do, after the first 2 secrets, we want to be kind of maybe thinking like, well, how is this going to affect us? Well, boom, there's secret number 3. It's all about how you guys can position yourselves to win in the economic system. So let's get into the good stuff, and let's get into secret number 1. Okay, so there's this massive problem in both the US and the Canadian economies. It's a huge debt problem that's in the room that we can no longer ignore. Okay, it's taken up a lot of room on the headlines, and it's slowly becoming more mainstream. But the federal debt in Canada, okay, just the federal debt, not even taking provincial debt, is a staggering $1.2 trillion right now. If you add in the provincial debt, the number just skyrockets to like a crazy amount, and we're going to see that in a second. But if you ever want to check out the actual debt, just Google Canadian debt clock, and you're going to take into this page where you're going to actually see how much debt we're racking up as a country per day, per hour. And the growth per day right now at the federal level, I laugh, but it's not funny. It's over $400 million a day. So no, like as Mr. Trudeau has obviously said, the budget will not balance itself at this point. We are past that point. We are just increasing the debt load day after day after day. So the federal debt that we just saw is about 1.2 trillion. This report was a little bit earlier than that number. That was an updated number. So we're at 1.1 right now, based on what I could track down and find. And it's a small change, but the point remains the same, okay? The country is severely in debt. And in fact, like Canada has to pay over $24 billion in interest payments on the country's debt every year. $24 billion on just servicing the interest payment, okay? Each and every year right now. And that's just the federal debt. And if you look at the debt as a percentage of the gross domestic product, or GDP, which if you think GDP, you hear that, think about how much money the country makes in a year, like an income, right? So if you started a business, you would want the income to be greater than the debt, right? Like you want it to be like this. Right now, it's like for this. Once the debt becomes too great, the company is going to fail, right? And right now, Canada's debt is sitting up here. It's 16% greater than the actual income that it brings in, 16% greater than the GDP. So this isn't where we want it to be. And this means that billions of dollars each year, over 24 billion for the federal debt again, $24 billion that's collected in taxes that we pay in taxes just goes towards paying off interest on the debt that we've accumulated as a country. Okay. Now, paying off debt's not a new concept. It's been around for a long time. But the real problem is that the bank and the government doesn't want you to know that the debt has been accelerating more recently. And you need to keep that in mind as we move through this presentation, because we're going to come back to that concept, and it's going to make a lot more sense. We're going to see how it's kind of impacting things as we go through, okay? Jumping over to the United States right now, we see the same thing, but to a greater degree already. The debt to GDP ratio is already at 125%, okay, at the bottom corner there. That's over 30 trillion in debt. They're a bigger population, they have more people, they have more debt. But as you can see, from 1990 to 2000 to 2012 to current day, the amount of debt is accumulating at a faster and faster rate, when in fact, the last 10 years, the amount of debt in the entire US economic system, it has doubled in the last 10 years, okay? It's while it's out of control, it's a huge, huge problem, all right? Why do we care about the US financial system? Well, because in Canada, being so close in geography, I was a geography major, shout out geography, okay? I don't use it anymore, but we're close in geography. What happens in the US can and does affect Canada because our economic systems and decisions, a lot of them, we just copycat what's going on in the States. Like literally, I think there's a guy out there who just calls up the US and says, what are you guys doing? Okay, we'll do the same thing. And it puts the phone down. That's what happens, honestly. Sometimes I feel like what happens, but we need to keep ourselves up to date with what's happening south of the border and just kind of, we always follow their lead. So that's, we have to kind of keep in mind as we go through this. If we jump ahead by 4 years, it is projected that the US debt will increase by another $48 trillion. That represents over a 60% increase in less than half a decade. So 5 years, adding 48 trillion. The debt right now is about 30 trillion. You're going to add 48 trillion more dollars right there, okay? Or sorry, $18 million to a total of 48 trillion, 60% increase. The rate of debt is accumulating at a faster and faster pace. That's what I want you guys to understand here, okay? So now we may be sitting there and asking ourselves, okay, well, we know that debt's increasing. Well, why is this happening? And what's the root cause of this? If we can understand the cause of this, maybe we can kind of get a projection of where it might keep going in long term, right, in the future. So let's dig into that a little bit, okay? This is from the St. Louis Reserve, which is kind of like the financial reporting metric for the United States and for other countries. It talks about the big banking statements, and things were running fine up until 2008. And then there was a huge financial crisis caused by the subprime mortgage lending issues in the US. And this is what the movie The Big Short was about, okay? And this chart's just showing all the debt in the US. And in 2008, the amount of debt kind of spiked and the housing market imploded. It almost collapsed the entire global economy. What happened was that mortgages were kind of being just dished out to everyone who wanted one without checking any kind of income, no stress test, nothing, just mortgage rates were just like giving to anybody. And then the mortgage actual rates increased on that debt and millions of people defaulted on their mortgage payments. Real estate market collapsed. There's an economic shockwave sent through the system. And after that, the pain just kind of set in and then something had to be done, okay? So that happened in 2008. This trend started. The economy was hurting. In order to sustain it, the US Federal Reserve decided to step in and inject more money into the economy. They went ahead and they bought up all the bad debt left over from the housing crisis. So what they did was all the people who didn't make their mortgage payments and just kind of let the debt sit there, someone still has to foot the bill. So the US Federal Reserve decided we'll pick up the debt, we'll take it in our books. And they did that. Plus they slashed interest rates to like almost zero to nothing, okay? That's important. But the main thing here to think about was that the economy was artificially supported and it was not allowed to fail. Okay, it took a steep step back, but it wasn't allowed to completely fail. It's kind of like if you were like teaching someone to drive for the first time, right? And whenever they drove, maybe they're a bad driver, they drove over the center line and you just had a hand on the wheel, pulled it back and corrected it, okay, back in the right lane. This can go on for a while, but if you weren't there just one time and they go over the center line, there's going to be an accident, right? So from 2008, the debt level started to pick up and it crossed over the 100% ratio in 2012. And that means just that the debt started to become more than the actual GDP in the US. So more debt than income. And it's really accelerated in 2020. You can see at the end of the chart there at the 2020 when COVID hit, it's accelerated more recently. And there's more debt in the system than ever in the US economy, okay? Here's another chart from the St. Louis Reserve again, showing the amount of money in circulation in the US over the past 60 years. So this is the amount of dollars in their economic system. And just as we just discussed, like look for similarities here, the crisis in 2008 led to money printing, okay? The government had to step in and take that hand and pull it on the wheel and pull it over by money printing, right? So we see there's a small uptick in 2008 of the dollars in circulation for the actual economic supply. And literally, I don't know how it works, but the US Federal Reserve and the Bank of Canada, they can just print money whenever they want to. They pull a lever, they push a button, whatever it is, and more money gets injected into the system, okay? And when COVID hit in 2020, the stock market, the real estate market, the economy shut down due to lockdowns, restrictions, supply chain issues, and a bunch of other things, right? It was a tough time for everybody. But at that time, instead of letting the economy kind of reset itself, we had that parent at the wheel again, pulling it back over and correcting things by printing more dollars out of thin air. And that's what was going on. And you see the quantitative easing there in 2020 and the amount of reserve currency or amount of currency in the US just kind of shot up from there because of all the money printing into the economy, okay? The exact same thing happened in Canada across the same timelines. So even if we don't like to think about it, our economies are linked, right? The pandemic has been a huge challenge for everybody. And the government's response, and I'm not like pro or anti-government here, I'm just outlining what they chose to do. And they chose to print more money, just like the US, okay, to copy them like step for step and delay the underlying problem. They just accumulated more and more debt, gave people and businesses new money to sustain themselves, and rightfully so, because everybody was hurting financially, right? And that's what they decided to do. So since the 2 years since the pandemic started, there's been an increase of money in circulation in Canada of about 20%. So in 2020, there's about $2.65 trillion in the Canadian economic system. 1 year later, 2.97 trillion. 1 year later, after that, current day, $3.16 trillion in our economy. So we have increased our money by 20% 2 years. How is that going to affect us? We just thrown $500 billion into our economy. Nate talked about this. When you put that money into the economy, it actually degrades the value of our dollar. And this is affecting us now. It is absolutely having an effect on the everyday person in more way than one. Okay. You can probably sit there and think like a few ways we're feeling it. Like we already talked about a little bit about them today. Okay. And it's just top of mind, like you're thinking things like maybe real estate has been on fire, and the average house price in Canada was up 21% from 2021 to 2022. It's highlighted there at the bottom, 21% change. Okay. It's interesting that housing prices are up year over year, roughly the same amount of the amount of new money in the system. So that makes me think the following: like, are houses actually more valuable, or because they're assets and they hold their value extremely well, have they just increased at the same rate that money was pumped into the system? 20% new dollars in the system in Canada. Canada real estate's up by 20%. Is that kind of how it's kind of linking the two together? Houses aren't actually worth more, but because there's more dollars in the system, they're going to be pushed up and inflated artificially. Okay. It's kind of like if you wanted to buy a bike and you were the only one there with $100. Okay. And the bike cost $100, you go buy that bike, no problem. Right. But if the government just sent out 4 more people with $100 around you, now there's 5 people kind of for that asset. There's 5 times the amount of money in the system. Then that bike's value might go up to $150 because, well, if the person selling the bike can get $100 from any of you, then there's more money in the system. Like they can charge a little bit more. The asset price is going to go up because there's more people with more money, and the value of your dollar is then diluted because you had $100, but now the bike costs $150. You have to come up with a little bit more extra cash to be able to purchase that same asset. The bike hasn't changed. There's just more money in the system. And that's what I think of when I see the housing market increase right now. Okay. And like, for sure, there are a bunch of other factors worth considering, like immigration. You got permits and housing starts, supply and demand, bidding wars, right? Interest rates, which we're going to get into a little bit later on. But in my opinion, the money printing has artificially inflated the housing market, and it's not the only asset class that has been kind of affected by this. After like a really crazy sell-off in February, in March of 2020, when I started like my stock trading, which is another story from their day, I lost a lot of money. But the S&P 500, which is just like an index fund, like Nate talked about, it's a collection of different companies. It measures the overall stock market performance. Okay. It crashed about 30% in 2020 and ended up making all those gains back and going up an extra 16% to end the year up 16%. Then it rose another 26% in 2021. Okay, so another 20-ish% for an asset class. Like that number keeps coming up somewhere. Okay, could the money printing be inflating the stock market as well? I mean, it's a possibility, right? Like the money being given out in the forms of like grants and loan programs, things like CERB, given to the everyday person, like, and made available to businesses, they were kind of filtered back in the economy somehow. So with that, and with interest rates being so low to borrow even more money when you had the option to, businesses could kind of survive. People kind of had money to kind of throw around a little bit artificially. And maybe these assets are kind of being propped up by these kind of injections into the economy. So what else is going on, right? Where else is being felt? We've talked about this as well. Inflation is creeping up. This is the Canadian Consumer Price Index, or CPI, which is just a measure of the cost of goods, excuse me, and services. So think gas prices, grocery costs, trips, vacations, restaurants, entertainment, shipping, any of that kind of stuff. It's all tied to the CPI. And it also started to spike at the end of 2021 at the right side of that chart there. The blue line starts to take off. It's the same kind of time frame as the money printing goes into effect. The quantitative easing kind of kicks off. And I'm sure you guys have noticed, we've talked about it again, that gas prices are nearing or above $1.60 a liter. And I remember the good old days, about 45, 50 cents a liter. That's back in like, I don't know, 1999, 2000, but the good old days are no longer here. It's 3 times more than that, right? And the cost of goods are going up, okay? And it's affecting your ability, it's affecting my ability to afford things that we need to survive and that we want to have in our lives, right? The US, Nate talked about it, is seeing inflation. It's about 7.5% year over year in 2021, meaning that if you have money left in a bank account and it's not bringing any interest, like it's losing 7% on a dollar in every year. That sucks, right? Right. And it's something that we need to be reined in. so that we can still afford to buy things that we want and live the lives we want to live. So yes, inflation is also kind of driven by some supply chain issues that have been kind of brought on by the pandemic. But the main thing here is that governments don't want inflation to run this hot. They like to have the mandate about 2% per year. So we are way above that, 7.5 to the 5% in Canada. We're way above that 2% level right now. This has to be kind of reined in, right? It's not sustainable, especially when we look at one of the biggest problems that's happening in Canada, that wage growth is not keeping up with inflation right now. So essentially what's happening, your time that you're spending at work is being stolen from you, okay? You work the same amount of hours, but you can't afford the same things that you used to be because they're more expensive, and you're not getting a salary increase that's the same or commensurate with what inflation is doing and with what asset prices are doing. And this has never been more true than in the real estate market right now, okay? If we look at income versus an asset class like real estate that has potentially been artificially enhanced through the government money printing, we see this gap widening at a ridiculous rate, and it's done so more often than not, right around that kind of 2008 level kind of took off. And then even now during COVID, it just kind of like went super vertical, okay, at the end of the chart there. Wages can't keep up. Goods and services are more expensive. So this all this limits what you can actually afford and limits your lifestyle. And it's because of these kind of inflated prices of housing, like buying and owning a home is becoming less and less realistic for the everyday person. Like it's troubling. And if it's not resolved, the reality is that there's going to be a shift to more people renting and maybe cohabitating in the future just based out of pure necessity at this point, okay? So you might be sitting there thinking, well, this sucks. I'm like, yeah, like it's not good. It's not a good thing. Like we've created this problem. And you might be thinking that there is something that could be done about this to correct everything. Well, I don't really want to burst the bubble, but when I'm looking at all this data and putting it all together in my mind, I'm trying to get the big picture of what's going on. And I think it's just a little trickier than just pushing one button and stopping it all, okay? You can't do that because it could come crashing down. But something has to be done, right? We just can't continue to pile on the debt and ignore this elephant in the room, or at least I don't think we can, or maybe we can. I'm not sure. Let's look into that. Let's get into secret number 2 and look at what the government's trying to do, what they may do to try and correct the issues that we've kind of created for ourselves, that they've created, or we've created, the system's created, and let's see what we can do about it. Okay, so interest rates and inflation. Let's talk about it. So the way that I see it, we got 4 options right now. Okay, first, the government and the banks of Canada can do nothing. Inflation continues to rip higher on its current kind of pace, and the debt keeps piling up. Now, I don't see this as realistic because ultimately citizens aren't going to be able to afford goods and services, and because of the slow wage increase we just kind of saw compared to assets and everyday items, it's not going to keep up. It's not going to work. So option 1 is not really on the table here. What about number 2? So we talked about GDP and income for the country versus debt. Well, if we increase taxes, there's more income coming in for the country. We can get that back in balance. But how do you increase taxes? Some of the ideas that I've seen is maybe changing some of the tax rules around real estate. Like when you sell a rental property, you pay gains on you pay tax on the gain of that property, on the profit, right? But when you sell your primary home where you actually live, there's no tax. You do so tax-free. So I've heard kind of rumblings about changing that rule, that you have to actually pay tax when you sell your actual primary home, which I don't think would be supported. I don't think it would actually happen, because how do you introduce that logically and fairly into the system after this crazy run up in prices? And the other way they could do it is if the government wants to raise taxes, they could just do it across the board, just evenly, but that's not going to be welcomed either, because nobody wants to pay more taxes. Like, we're getting taxed enough as it is. Imagine a politician's campaign running for office. Okay, we're going to raise taxes, and in 10 years it's going to be better for us, but right now you have to pay more. That's their political platform. No one's going to vote for them on that. But that's not a realistic idea. Okay, so I don't see that going over well. Plus, like I said, we kind of paid enough in taxes already. People are stretched with their budgets. I don't think it's viable. That brings us to option number 3, which is all about interest rates. And this has been done already. Todd alluded to it. Nate alluded to it. This week, in fact, the report came out. There was a 0.25 percentage point increase by the Bank of Canada. Okay, and you may have seen this headline in the news outlining the move. And then the big 5 banks in Canada also did the same thing. So this is actually happening. This is in real time. And there are additional rate hikes kind of projected in for the year by analysts, anywhere from 3 to 5 more hikes of a 0.25 percentage point. So if that's going to happen, that's the trend. What effect does this have, right? Well, by making it more expensive to borrow money, which a lot of us are doing, and that's the way the economy is kind of built right now, there's debt there. In theory, it's supposed to limit the demand for goods and services by making it harder to borrow. And if demand goes down, then the price should follow and come down as well when there's less buyers in the system. But this also comes with side effects, okay? For starters, anybody who has a variable rate mortgage, like Todd said, where the line of credit isn't locked in, is now paying a quarter percentage point more for the debt they're holding. Not a huge game changer yet, but if we get to those rate increases we're talking about, you're going to see in a second that it could be bad, right? And this includes businesses as well who have loans, and this includes the federal debt and the provincial debt out there. So interest rates are low compared to what they were 5 years ago. And in theory, there's room to grow and keep increasing them. But are they actually going to do that? Like, let's not forget about the debt that we're carrying as a country. We talked about it a little bit earlier. We're coming back to it now. We're back to the $2.7 trillion in debt, and a quarter point increase on that debt just added more to the total that has to be repaid by the country, not let alone like you and me as a consumer, but the actual national and provincial debt. How much more we're looking at? That quarter point just added an extra $7 billion to the national debt every year. And that's just with one rate hike. So if we get to 4 hikes, like a lot of people are talking about this year, it becomes a almost $30 billion increase to the debt load. And if like by some crazy stretch of imagination way we get to 8 rate hikes a year, would be about 2% increase in interest rates, we're adding about $55 billion to the debt load. And that $55 billion is currently where we're at right now for the country. So we would just be doubling our debt load in the matter of a year. I don't understand how that's viable for the government. And I don't see how that can be in play because we already have more debt to income than as a country. How are we going to double our debt in the course of a year by interest rates rising? So it's just going to increase the magnitude of the problem to the point where it can't be fixed. And I think it's already at that point, but we're hoping to tame inflation and slow down rising costs of goods, but we can't keep raising interest rates because the debt load is going to be too much. Like I don't see that how it's possible. So I don't understand when people are saying 4 to 5 to 6 to 7, 8% hikes. Like that doesn't make sense to me based on these numbers, right? I'm just kind of putting it all together in my head, and feel free to disagree or agree with me, but to me, it doesn't make any sense. Okay. I don't think they're going to raise interest rates more than like a couple of times this year and then see what kind of effect it has on the economy. But let's keep going. Okay. So if we do keep raising these interest rates, and it does happen, it makes it more difficult for people to make their debt payments, number one. Defaults could occur. Businesses are going to be kind of hurting for cash because they're paying more for their money they borrow, right? And the whole system is kind of choked out if rates raise too high too quick. And that slows down growth. And it kind of turns into like what's not commonly, but the word recession kind of gets thrown around in conversation. And based what happens on 2008 and onward, like if that was to happen and we choked out the economy, what do you think's going to happen then? There's only one real answer at that point. What's going to happen? Somebody has to happen to bail everybody out again and keep that car driving in the right lane and avoid that crash. So the wheels going to be turned again by somebody in the passenger seat, and we're going to avoid that crash again. Okay, so Q option number 4, if that's the case, we're going to do this. We're going to keep raising interest rates. We're going to keep printing more money. Like that's the reality that I come to. Like if we do this and we keep raising interest rates and the cost to borrow goes up and it kind of chokes the economy, makes it tougher for us to pay off our debt and the national debt. If they just print more money, that's the only answer that I see. You can't raise taxes. You can't do nothing. You're going to try to raise interest rates, but just keep printing more money. Like after 2008, 2020, when the major problems kind of surface, there's only one way to keep it kind of functioning, right? And avoid collapse. And that's just put more dollars into the system. And if that's the case, and that's where we're headed, should we just then expect the prices of assets to keep chugging along the way they have been? Like 20% returns are great if there's actual value behind them, but we don't want to see 20% in the stock market or real estate year after year. Like the problem is that if this money printing continues and these assets keep going up, it's not that they're actually worth more money. They're still the same kind of brick and mortar house, or it's the same company it was a year ago. Like there's just more money in the system. So prices are artificially enhanced along with the economy. It's not a good thing. It's not an actual 20% gain. There's no actual real value there, right? So then what happens? Like, what's the end game if the money printing doesn't stop? Where are we headed then? And like, what's Thanos going to do? What are the Avengers going to do? Try to finish off the end game? You know how the movie ends, but how does our kind of story end? Like, the truth is, at some point, when something artificially propped up over time, eventually it's going to collapse. And I don't know when that's going to happen. I don't want to claim to know when that's going to happen, but I don't even know what it's going to look like maybe, but it's going to be an economic reset of some kind because we've just been kicking the can down the road for so long to deal with the problem later. And eventually gets to a point where the debt load's too much. And maybe as a country, we can't afford to fund necessary programs. Maybe there's political unrest, fighting. I'm not sure, but it's not going to be enjoyable. I know that for fact. And unfortunately, this is the system that we created ourselves. We are the ones who kind of made this happen. There's no easy fixes. Like the bank and the government is going to try to do everything they can to delay this from happening. But in my opinion, we're on trajectory for it. It's going to happen. It's just a matter of when. Okay. So if we have an idea of what's going to happen, this kind of economic reset's going to happen, we need to start prepping for it now for that untimely situation so that we're prepared. And there's a few different ways you can do that. But ultimately, what we want to do is create a much better support system for ourselves and create that 12-legged table, okay? So a basic financial kind of makeup for people looks a little bit like this. You have an income from a job, and hopefully there's a pension tied to that income, and then some savings maybe. That's not always the case though, but most people have a credit card and they are used sometimes for emergencies, but that's not the best way to do them, but it happens all the time, right? So everything at the table there, basically, if you're very, very like focused on one thing, is just income, okay? If income goes away, it's like the table leg is cut. And if the table leg is cut, the table starts to tip over a little bit and falls, okay? Losing the income from a job then affects the strains on your savings. If you're using your savings to kind of fund your lifestyle, then the savings dry up. And if you have to kind of get into your credit card, that's another issue, right? And if you do have a pension statement, which you can actually access, which usually only happens like past 55, it's not going to probably be enough to compensate if you just have that quick job loss. So what happens, right? The table falls over, and in real life, that means financial strain, worry, stress of not paying bills, maxing out credit cards, falling further and further behind, maybe bankruptcy, right? Ruining your credit rating. The cost of goods and assets are going up in value, so you still can't afford things. So there's all these kind of things that kind of pile on and push that table over. We don't want this to happen. Like, I don't want this to happen to me. I don't want it to happen to you. Hopefully you guys are here listening to this to kind of protect yourselves. And if you're in a situation where you have a four-legged table for yourself, now is the time to think and rethink about the risk you're taking on by not having more legs to support you. We need to figure out ways to go get those extra legs and get that support system in place, okay? So how can you protect yourself and your assets, and how can you withstand a pullback in the economy if that's where we're headed, right? We just kind of went through one with COVID, and if we see it again, we want to be ready for anything long-term. And it all starts with one thing, and that's income, okay? The higher you can take this, Nate talked about it, if you want to be a game changer, you want to be able to save more, you need to make more. So generate more money for yourself, and you'll allow yourself to access more opportunities. If you only make 25K a year, it's hard to live on. I get it, right? There wouldn't be enough to invest if you made 25K a year. It's going to bills, food, transportation, other expenses, right? That's all it is. If you have a higher income, then you can invest in yourself, you can invest in knowledge, you can kind of learn how investments work, and you can start to understand how compound interest works, what we've already seen today. And once you have that knowledge base, you can get started. And if you do have a high enough income, you can even start to use other people's money when you're given access to credit and just kind of supersize your investments, right? It's how the majority of super wealthy people get ahead financially. And that's the reason why it's been kind of honed in on today's presentations, like use other people's money to get started if you can. So doing all of this, and this is what it looks like, it's going to give you far better support than a table with four legs. Like, you're going to be having all these extra kind of support. That table's not going anywhere. Like, there's all that stuff: income, insurance, savings, education, stocks, dividends, real estate, cash flow, appreciation, crypto, gold, silver, line of credits. Like, all that stuff protects you and makes your table that much stronger, okay? And maybe you guys have started a couple of these, maybe not, which is fine. But my challenge for you guys today is to start and do at least one more. Do a little bit of research with one that makes sense to you, like at a basic level. And everyone's gonna have their preferred kind of investment vehicle, but pick one and get started. Like, the sooner you start, the more prepared you're gonna be for when this actual economic shift happens. Okay, you want this 12-legged table, best case scenario, get a couple legs under there. If you only have 4 right now, keep adding to your table, keep supporting yourself. And how do you increase your income? Well, from experience, I can give you kind of a couple tips here. You want to increase it as much as you can without putting in more hours. Nobody wants to work 80 hours a week and have no life. There's a work-life balance here. Today's event's all about buying back your life, buying back your time, okay? This is gonna take dedication and a commitment to your craft, but it's 100% possible. The fastest way that I started to earn more money when I was working like a full-time 9-to-5 job, I'm an entrepreneur now, but I switched positions. I had been getting like 2 to 3% raises annually, much like we saw about the wage kind of headlines in the previous slides. But I thought I was worth more than that when I was being paid. So I actually stuck it out for 7 years at the same company, thinking like, if I just keep grinding it out, it's gonna be good, it's gonna work out. And it was probably too long in all seriousness. And I went out and applied after 7 years to new companies and ended up getting a 25% raise by switching companies. Then 2 years later, did the same thing. And it was another 25% increase on top of that. So that's when I started to kind of stack my income and see that, okay, I actually am worth this stuff. So it's much faster to build it that way than slogging out for 3% a year. But if you don't want to do that, ask yourself the question, how much are you really worth? And then go look around and find some other kind of comparable roles to what you think you're worth, where the income matches, and go ask your boss for a raise if you think you deserve more. Like, put on paper, why do you deserve more, with some points, and go ask. Like, if you don't ask, you're never going to get it. No one's going to hand you a big 25% raise because you're doing a good job. You have to go get it for yourself and take control of your future, okay? And then once you have your income kind of locked down, as we've gone through in previous slides, the banks love lending and they love taking on debt. That's just the way the system is. And it's kind of collapsing upon itself, in my opinion, but that's the way it is. So we need to position ourselves to win in this system. And this is how you really accelerate your returns, when you're able to borrow the bank's money and use it to make money for yourself. It is like infinitely faster than trying to save up extra cash for all your investing. And you should always have like an emergency fund, but when you can invest other people's money and you're comfortable with the risk, which just kind of comes back to your knowledge of the investments, it makes sense to do this because of the math. And here's what I mean. If you were to buy a rental property, the banks only need you to put down 20% of the purchase price, okay? You get to borrow 80% of the value of the asset, which is just fantastic as an investor, okay? Give me that deal all day. This is known as leverage, and this is access that has helped 90% of millionaires use real estate to add to their net worth. It's just a crazy powerful investment strategy. Why is that? Because you get to control the asset for a fraction of the overall cost. Houses generally go up over time. This is known as appreciation. And if we have that 10% rate of return, right, which is kind of like half of what we've been seeing lately. Lately, it's been 20%, but if we get 10% on a $500,000 home that we control, it's worth 50K. If appreciation stays at 10%, you get about 50K added to your net worth each and every year. But you only invested 100,000. So you're generating 50,000 on 100,000 invested, which is about a 50% return on your money. That's crazy return, right? So if you would have just taken that 100,000, invested 10% in like the stock market or something, it would only have been $10,000 return, which is a $40,000 difference, which is just huge. But it gets better because with real estate, you can actually rent out the house to somebody who will pay down the mortgage for you, cover the expenses plus a little bit extra, which gives you some cash flow. And if it's done properly, you get to use other people's money again and get ahead financially because it's so the bank's money and renters' money, and you just get supersized and get thrown ahead financially, okay? But it's not just real estate. You can do the same in the stock market. If you were to borrow $100,000 from a line of credit, let's say, again, borrow other people's money and just invest it into some index funds like Nate was talking about, the average rate of return is about 10% overall for the market. So you make about $10,000 after year one. But it costs you about $3,000 or 3% to borrow. So you walk away with $7,000 in profit, okay? And that's just 1 year. When you do that year over year over year, going back to compounding interest, right, the eighth wonder of the world, after 30 years, you take the 100K, you never invest another dollar, and you're already up to over $750,000 using somebody else's money and paying off that interest, okay? And this can be very passive, like clicking a few buttons on your phone, like once or twice a week, and getting everything automatically set up to go. Okay, so like hopefully this is sinking in, like how you guys can do this and how you can set up for yourself and how it works. These are just two examples, but you can apply this to business, like building a business for yourself, investing in crypto, investing in gold, silver, insurance policies, tons of stuff out there. We just are scratching the surface of like the concept today of how it works. There's so much opportunity out there for you guys. And if you can make sense of the investment and understand what could go wrong before jumping in, having a plan for worst case scenarios, then you should be able to manage the risk part, right? If you understand what's going on. It just comes down to educating yourself and learning from experience, okay? And the second part that I want to touch on, and it's so important, is to borrow only to invest. You want your money, especially borrowed money, to make you more money. We don't want to go and get in trouble by buying vacations, buying that new truck, or like spending on clothes and different stuff, instead of trying to accumulate more assets with borrowed monies. We want to be building more legs under the table as often as we can to give ourselves that support, okay? And you can actually get started today. Like there's resources here that I provide for free. That web class is every week on Thursdays about stock investing. The newsletter comes out every Thursday as well. The Buy Back Your Life podcast, if you haven't seen that one. But there's Facebook groups, there's YouTube, there's podcasts, there's actual like books like Think and Grow Rich that we talked about earlier, right? All these books, Reddit, Discord, like there's so many options out there. This has been like the best time ever for you guys to go and get educated. It's all out there for free. You can follow up with Nathaniel or Todd, our guest speakers today as well, or myself, and just go and get started and start building that support for yourself, because it's so essential for you to do that. Find some like-minded people, get together with them, share the concept you're trying to work through, find a mentor, right? And just get started. If you surround yourself with people who are taking action and doing what you want to do, you will go ahead and you become that next person that does that. It's the old adage of the 5 people you spend your time with is the kind of person you're going to be. So if you find 5 people who are just crushing it in life, and you surround yourself with them all the time, you're going to be crushing life too. If you want to be a good athlete, go hang around with athletes. You're going to be the next best athlete, okay? If you want to be a good cook, go find some cooks, hang around with them, pick their brain, talk to them. You'll become a better cook, right? That's how it works. And where you are now today is because of what you did 5 years ago. You set the standard 5 years ago, and what you're going to be in 5 years from the future it also comes down to today and tomorrow. Like, what are you going to guys do? Like, your actions today are going to generally set you up 5 years in the future. Like, I've been doing this kind of investing stuff for 10 years. So it's been 10 years of building, but the first 5 years are kind of learning phase. And then the next 5 kind of just kind of supersize me. But those first 5 kind of set the foundation. The next 5, I kind of fine tune things. And now I'm at where I'm at. But it's what you do today in the moment that's going to kind of filter through and set you up for success in the future. Okay. So quickly, again, to recap for you guys, we talked about these 3 economic secrets. We went over the debt elephant in the room that can't be ignored. It's getting larger by the minute, and it is a problem. Then we thought out loud about inflation and interest rates and what my thoughts are on interest rates. Again, feel free to disagree when you want to, but it's likely that more money printing is going to happen. And I don't think interest rates are going to rise like people are thinking they're going to. We're going to do like 1 or 2, kind of see what's at and kind of go from there. And we just went over how you can kind of protect yourself by building yourself a 12-legged table through investing, increasing your knowledge, and using other people's money. So at this point, if anybody has questions, we'd love to get them in the chat and you can go through it there. But that's all I got for you guys for this presentation. Hope you guys understood that, enjoyed it. It was a lot to go through. It's kind of a deeper dive into what's happening and why it's happening. So I hope you guys found some value in that, and feel free to throw some questions in the chat. Just gonna grab a drink of water here because I am parched.